Better System Trader, episode 39.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Welcome to the Better System Trader podcast. This is episode 39, and I'm your host, Andrew Swanscott. We've been very lucky to have a number of trading champions on the podcast in previous episodes, and this time we get to talk to another successful trader, Michael Cook, who won the World Cup Trading Championships in 2007 Futures Division, 2011 for stocks, and again in 2014 for futures. Michael worked in the institutional world for a number of years before leaving behind the banks and the hedge funds to trade for himself. In this episode, we'll be discussing how to increase returns with the same risk, using the market to determine stop levels, selecting a position sizing algorithm, and the role of discretion in systematic trading, which I'm sure will fire up some of the purists just a little bit. Anyway, let's get to it. I hope you enjoy this chat with Michael Cook. Hi, Michael. Thanks for joining us today. If we could just please start with a little bit of background on yourself.
Yeah, sure. Well, I guess I got started trading in about 1995. I had traded prior to that in college and times, but starting more serious trading was, 95 with a big US commission shop I was working for, or a broker called Payne Webber. And that was one of the last of the hard commission shops. So what that means is that people, every time they did a trade, they knew precisely how much money was going to go into their own personal paycheck. And the obvious implication of that was it was highly, highly aggressive. Now, I wasn't actually on the trading floor, but I was supporting it. And I noticed a guy beside me who'd been doing his job for quite a while, spent all his time spread betting, which is a type of firm we have in the UK. And he was doing sports betting, but I mean, pretty much professionally sports betting all day. And I was quite intrigued by this. And at the time, there were only two spread betting firms. There's probably a dozen now. But looking at what he was doing, I had a look at these firms, and I realized they were offering all the financial contracts as well. So he was doing sports, but I suddenly got interested in the fact that they were doing all these financial contracts, including quite a few that were hybrids and didn't actually exist in the outside world, as it were. And I found out they only had 3 or 4 traders doing all these markets, and I thought, well, you know, we have dozens of traders upstairs and they're covering half of this. So if they've only got 4 or 5 guys and they're trading all of these different markets, mistakes are going to be made, or not necessarily just mistakes, not picking people off, but they're not going to be able to get it right, and there's sort of money to be made there. And that's what first got me started and what I first became interested. So I was trading quite a lot with those guys. So I guess that was the sort of start of things. And then I was putting myself through my first postgrad in evening school in order to get a job on a trading floor. And I was offered a job with Payne Webber, but on the sales side. And at the same time, I'd actually been interviewing outside, so I moved on to a big trading house and joined them on their trading desk, which is what I really wanted to do. And from that point on, I was a full-time trader. So that was 97. So what's that? 18 years ago now.
Yeah. Okay. So when did you actually get started trading? You're not so much for an institution, but for yourself.
Yeah, I was doing that quite a lot. Anyway, whilst I was with the banks, and then I worked for a couple of hedge funds and things who were fine with me trading my own stuff as well. And when I left the bank for the second time, because actually I worked for Bank of America twice, I really wanted to trade my own money. I mean, that's really what I wanted to do full time. And the problem is, it's very much used as saying you're going to trade your own money is very much a euphemism for I've just been fired. But there's a tiny, tiny subset of people that when they leave banking say, I want to trade my own money, what they mean is, I want to trade my own money.
Yeah.
And that was me. I was sort of bonus day walkout, and I'd been preparing for that for quite a while. So that's what I did. So I did go on and work for various hedge funds and things, but I was always quite actively trading my own stuff from that point onwards.
Okay, so back then, what styles of trading were you doing when you were trading your own money?
I tried pretty much everything. I did the same sort of process that everyone seems to go through. So I certainly had equity stuff I was trading. I liked futures quite early on. And also there was a sort of seminal event, which is I knew that I was going to be moving abroad somewhere. I didn't know where, to do with my wife's profession.
Mm.
And it could well be somewhere sort of quite strange. And I certainly knew I wasn't going to be doing, institutional fixed income from wherever we ended up. So it needed to be a very portable market. So that's really when I finally decided, no, it's going to be futures. And the sort of style, I guess, was it varied actually. I was doing some spreading that I found some interesting stuff in, and doing some swing trading as I do today, and pretty much anything that worked. But it was futures. And related options markets and a little bit of FX, but all of those mainly just vanilla futures.
So was that like a discretionary type of approach back then?
It was a lot more discretionary than I am now, in the sense of it was what I would term actually discretionary, proper discretionary. The whole discretionary question is interesting because I think Martin Luke, from AHL, or AHL as was, and now Aspect, obviously, he made some comments about when people say they're 95% systematic with a 5% discretionary overlay. What they mean is they're 100% discretionary, and I can see where he's going with that, but I think there are different sort of levels. If you're just analyzing the market empirically, then you are pretty much completely discretionary. But in reality, you can have certain discretionary aspects to do with execution and things where you are really just you are pretty much systematic. But in those days, no, I was much more it was much more heavily biased towards the discretionary side.
Okay, excellent. We are actually going to come back to discretion a bit later, but if we just talk about the style of trading that you do now,
yeah.
Can you give us a bit of an idea of the markets, the style, time frame, etc.?
Yeah, sure. Because I've moved again now, and the first move I ended up in Alaska for 5 years because I moved again now, and I'm practically a neighbour of where I think you are, and I'm in Western Australia, so I'm a couple of thousand miles away. That comes with certain constraints, and the very obvious constraint is the time zone. So the stuff where I was what I would term heavily systems-based, now I'm fully automated or algorithmic. So those kind of systems, those are developed in the traditional way, and I switch my systems on a Sunday evening here, and they get switched off on a Friday, and so they do everything. They enter, they exit, they position size, all of that stuff is fully automated. Those systems are typically 2 to 5 days duration, liquid futures contracts, so nothing particularly unusual there. And then I do a lot of options trades and things like that, but they have to be done in such a way as I can get all my orders in when the liquidity opens up about 8 or 9 o'clock at night, Western Australian time.
Mm. Okay, so this is kind of an obvious question, I think, but why does a systematic approach to trading appeal to you?
It appeals in many ways. Let's go through them. Firstly, what I just said, the time zone thing. So it appeals in the sense of it doesn't force me to stay up all through the night. So obviously that's quite appealing. So there's a practicality sense there. It also allows, for instance, if you happen to be trading on your own, which essentially I am, I have people who work with me, but that's more on the research side. So as regards the actual trading, it catches everything. So, for instance, it's pretty much eliminated the issue of if I happen to be outside or on the phone or anything else or on holiday, it carries on trading. The level of robustness of the systems now I mean the actual platforms for trading, is such that I find I can pretty much trust them. I keep an eye on them, obviously, and check them every day, but it's a kind of check them once a day thing. And certainly they're set up so that all sorts of things start happening if they ever go down. And I can't actually remember the last time that happened. So everything just sits on remote servers, and that's all done. And the discretionary side of things, you can sort of just not do it if you want a few days off. But so that's clearly one appeal. The other appeal is really quite simple. A lot of these systems take advantage of various types of market behavior which you've tested, or market psychology. And the reality is, even this week, I've had a classic example, but it's the trades you hate, the trades you look at that and think, I'm not doing that. You know, that's a disastrous trade. That's the one that's going to win. I mean, you can almost guarantee it. The one you most hate and the one you absolutely love. And this is why I always laugh at people who talk about their high conviction trades, which is fine. I mean, as a concept, I get it. But I always think, my highest conviction trades invariably are the ones that have killed me in the past or have been really big losers. Whereas, of course, if you're fully systematic, a computer doesn't care what you feel about it. It just does it. And that's the sort of level of discipline that quite often you need with this stuff. So, for instance, if you've seen a market decline massively, as I saw this week, and then go short it, that's the sort of trade where you think, oh, that's terrible. Because, of course, it's going to retrace at least to some point. And no, it didn't. So the whole disciplinary aspect, I think is quite important, and those are the real benefits. And there's also, other ancillary benefits, which, for instance, means you can monitor more markets at its simplest. It doesn't take that much computing power, and certainly, any personal computer you buy now can do it. And if things are sitting on cloud servers, then you sort of trust the latency of data and all of that kind of thing. So all of a sudden, whereas if you were discretionary, you can be analyzing one market to death, and there may be a few more. You could look at gold and look at a currency or two and look at stocks, but there's nothing stopping you theoretically monitoring 60 markets or 70 markets if you're doing them algorithmically. You just keep on adding more and more systems. So those are the main ones.
Yeah, that's some good points there, Michael. So as you mentioned, you've been trading for a while and you've tried many different styles of markets. Has there been any major influences or events that were key in developing you as a trader or your approach?
Oh, yeah. It's funny, I sort of have a slightly academic side of life where I've done various postgrads and things in areas utterly unrelated to trading. And there's a comment that comes up a lot in international relations and stuff about generals fighting the last war. And there's all sorts of historical data on this, and building trenches in the Second World War, which of course just get driven around by the tanks who just wander into Belgium and bypass all of that, and all this kind of stuff. And trading, I think, is very similar to that. So, my problem was my first war, or my last war, I guess, was when I started trading. And when I started trading, remember I said about moving to Bank of America in '97. That was on a trading desk. That was actually trading emerging markets, and emerging markets were right in the middle of an almighty problem in '97, especially towards the back end of it, with what became known as Asian flu, issues with Korea and contagion spread across the region. And then that moved into '98 into Europe, and Russia defaulted, and we had the LTCM crisis. And so I was trading all through this, and this was my first experience of being totally immersed within it by being on a trading floor. So that was a seminal influence on how bad things can get and how fast it can happen. A lot of stuff we traded essentially went from 100 to 0 to all intents and purposes. So that sort of coloured me, and I think it's quite common for traders to be very good loss takers, but they tend to take profits too quick, or very good at running larger levels of risk to take large profits, but of course they happen to take large losses. So my tendency, for instance, from that set of events is I think I'm too conservative. Invariably, I under-risk things, and that's not particularly good. That's a failing I have to work on. And I feel quite ill when I hear some other people I know talking about how they trade. And I'm thinking, yeah, I could never, psychologically, I couldn't take that. That's why, for instance, I could never be a long-term trend follower. Not because I don't think it works, but because I just don't think the psychology, the behavior you have to deal with involved in that trading style would suit my psychology.
Mm. That's interesting, actually, that you say that you under-risk things, because you've actually won the World Cup Trading Championship a couple of times with some pretty good returns. So,
well, they were kind of the exceptions. Yes, that's true. But equally, if anything, the individual trades were all quite low. The level of risk, what I've constantly tried to work on is how to sort of eke out more performance from a given level of risk. So yeah, those have been quite sort of large percentage returns, but they've also been relatively small accounts. That's the other thing to bear in mind. You trade a very small, it's real money. You see your trades going through the market and everything, but you trade those accounts somewhat differently to how you trade $1 million or $100 million or, larger.
yeah, okay. So why did you enter the World Cup Trading Championships?
Yeah, I remember this quite clearly. I hadn't really done the seminar circuit or anything, but I'd been to a seminar. I seem to remember it was at Heathrow Airport, which is one of the main airports for London, that was held by Larry Williams. So I do remember going to one of his, but that's the only one I remember at the time of having gone to. And then I knew I was going to be doing this move, and by that stage I knew it was going to be Alaska. So clearly I wasn't going to be doing institutional stuff out there. I was going to be trading futures, and I kind of had to think about it, and I thought, well, there's a problem here, because in emerging markets, I think it was a relatively small market in London, and I probably knew at the time I was doing it, a third of the traders doing it in the London market, or maybe a half. I was involved in a big social event that still goes on today, and things like that everyone used to get together, and it was a very, very sort of small niche market. And then I thought, now I'm going to be doing futures in Alaska, where I don't know anyone and no one knows me. And, that could be a problem, because you're trying to interact with people and that kind of thing. So I dropped a note to Larry, and I said, look, this is the problem. I think I'm quite decent, and I think this is going to work out, but what do I do here? Any ideas? And Larry, goodness knows how many emails he must get every day, but he did respond straight away, and he said, all right, well, if you think you're decent and with what you've said, what you have to do is enter this trading contest and win it, and then people know who you are. and in true Larry style, it was this sort of stream of consciousness email, so it was about 2 lines long. I still have it, actually, because I thought this was kind of the start of things, was that email.
Yeah.
No caps, no punctuation, but he responded, and he had no idea who I was. And we've kind of been in touch in some way or other over the years since, but he said, you need to do that. So I thought, okay, well, that's what I'll do then. And that's why I entered.
You make it sound so simple. This is all you need to do to get...
Well, it was just filling out a couple of forms. It was fine. Oh, and you had to win it as well. That was a bit of a problem. But
I think Larry's been responsible for quite a few of the
whole generation, I would think.
That's right. Well, can you give us a bit of an idea of the trading approaches you used during those competitions?
Well, what I tend to do with the World Cup is I use those accounts because, like I said, they're unusual in that they're relatively small, and you're obviously trying to achieve very high levels of return. Typically, 100% may get it done in a slow year, but generally it won't. Generally, you need a couple of 100% to be thinking about winning. That would win it about 2/3 of the time. So that get you in at a standard deviation, if you like, in stats talk. So, you need to be thinking about what's gonna achieve that. So I tend to use those accounts for any new ideas I have. I use them as the final sort of test part of the process. So, we all do the same process in testing engines and things and developing stuff. And every time I think I've got something new, I tend to enter it in the competition. So the result of that is that each year is often completely different to prior years of what I do with things. But it's handy because it's a year of real trading, but not with putting too much money. So not getting over your skids with it, but at least live trading it and seeing how it works, and then just getting a feel for, is everything matching all your conceptual testing and all of that in a real environment. So specifically, for instance, I was doing calendar spreading in 2007, the first time I won, and that was something where I just analysed in a very manual way the rolling process and some phenomena that were becoming clear within that, and there was clearly various forms of trades to do with the rolling process that became known as the Goldman roll, but there were 2 or 3 different types of trade, and I thought I'd identified one. And I loved it because it was hugely manual in testing. So I had to physically print out I couldn't code it. I couldn't work out how to do it, and I couldn't actually work out how anyone could do it. So I had to physically print out hundreds and hundreds and hundreds of pages of graphs in order to see if this phenomena was what I thought it was, and it did appear to be. And then in 2007, I was actually trading that, and that worked out quite well.
Okay. And what about in 2014 as well? I think you also won the competition.
2014, yeah, that was a completely different. So no spreading there, or no calendar future spreading. Larry Williams had made a comment about, or he frequently makes this comment, actually, it comes up in all sorts of places, about betting big to win big is a misnomer that's put out by the casinos in Vegas, and that's not how you should trade. And what you should do is bet small, in effect, to win big by identifying large moves. And in that way, that's the correct way to trade. And I sort of, I broadly accept that concept, but I thought more and more about, well, what if there's a way of brute forcing yourself into the middle of that contradiction, in effect? And is there a way of betting big but keeping your risk quite low? And my sort of solutions to that problem is what I was doing in 2014, and that was with both outrights and option spreading.
Okay, we might actually come back to that in a minute because that's interesting. I'd like to hear what your solution was.
Yep.
So another question on the World Cup trading competition. So obviously you won and people knew who you were. How did being involved in that competition impact your life and your trading? Like what were the benefits of participating in that?
Well, the benefits, I guess, the most unforeseen benefit I got was quite simple, which is the year following my win, which was 2008. I think I actually came second in that anyway. That might not be right. But the year following my victory, they started, the exchanges became a sponsor to the event, the Merck in Chicago. And they started holding the award ceremonies on the floor, which was great. Got to be on a different sort of trading floor to the sort I'd ever worked on, an actual futures trading floor. And I got invited as the immediate prior winner, and that was the first year of many that Andrea Unger won. The chap I think has been on the podcast, who's a good friend. And what I got from that was the fact that the 5 or 6 people who were invited to that as the people who were placed in that competition, and myself, we managed to get together and we all formed quite a strong relationship, and it was just amazing to spend a bit of time with those guys immediately after the event and find that we're all from different bits of the world. Rural Canada, me, a Brit living in Alaska at the time, an Italian guy, a New Zealand guy, all a guy from Midwest in the US, all these different people, and all we'd been struggling with exactly the same issues independently, and it was just very interesting to discover this in a sort of a very you could read about it and that would make complete sense, but to actually talk to people, say, can never do this, or I found a solution to that. Or so essentially, it was building relationships with other people, and I think there was a development within the competition where the people entering were getting more and more professional. I think there'd been a period where I want to be careful how I put this, but people were more aggressive and less professional in their approach, maybe. And at this point, there seemed to be more and more people who were treating this in a very serious way about how they were going about process and things. And that was the sort of just after, that was just before me. That was, I think, because Kevin Davey would squarely be in that category as well, who won in '06, I think. So, yeah, that was the big benefit. The big benefit was all the guys I got to meet through it, and we kept in touch in subsequent years.
Oh, that's quite an interesting response. I wasn't expecting that. I guess, especially when you're trading or trading your own money, trading can be quite a lonely endeavor. So,
yeah, sure.
It's quite interesting that you mentioned that the opportunity to meet other traders was one of the benefits. So that's really cool. So one final question on the trading competition. Because it's just started for 2016, do you have any tips for those who have entered or are considering entering?
No, I wouldn't be that presumptuous. Actually, I can think of one tip, which is don't give interviews to people immediately after laying hostages to fortune, for instance. So a certain idiot who might be talking right at this moment, I gave an interview to, I think it was Brent Penfold, actually, but it was one of some guy, and I said, you know what would be really, really cool would be to win this competition 3 years in a row, because no one's ever done that before. And the problem was there was this guy in Italy called Andrea Unger who read that and thought, he's spot on, that would be really cool. And then he promptly did it and completely shut me out of the competition for the next 3 years. So maybe the advice is, don't do that, because that's... and Andrea is a wonderful guy. I mean, I know him well. But I do remember quite clearly saying that, and I remember meeting him then subsequently to him saying, "Yeah, I thought that was quite right, so I did that." Thanks, Andrea. That's great.
Oh, nice one. That's great. Okay, if we can just jump back a little bit now, back to your the statement you made about the contradiction between betting big to win big and betting small and identifying big moves. Now, you mentioned you were working on a possible solution for this in 2014. Did you come up with anything that you think works?
Yeah, I mean, conceptually, we all use, I think, it's pretty common to use a cash stop loss. Okay, fine, with futures trades. I use them. I don't like them being activated, but they're in as the final, the final catch rope on an aircraft carrier before the plane drops into the ocean. So, you always want to have one, but you don't really want that to be the stop that actually takes you out of trades. You want, far more market-related stops to get you out, because obviously the market couldn't care less what your pain threshold is. It's really neither here nor there. So where I was trying to go with this, as I sort of alluded to earlier, was, is there a way of packing more risk in by getting stops lower? Now, what I'm not talking about is just reducing your stop size by having a very small cash stop, for instance, because clearly that just gets you a lot more stop outs, and you do need room for markets to breathe, or for the inevitable noise. So take that to its logical extreme. If you had a 1-tick loss, stop loss, then of course you'd have 100% losers. So that whole thing about running profits and cutting losses is true as far as it goes, but it doesn't go far enough to be particularly useful, other than an extremely general concept. So getting back to that, I thought, well, if you have various stop levels that you've already identified for other reasons, not for the not for the reason that they're small, but for instance that are, let's take some very simple examples, market related. So for instance, a prior low in a long trade might be one, or a prior high. So you could have entries for a system whereby you expect an immediate move in the correct direction for whatever reason. And if not, then you've in effect negated your thesis on the spot. And say, let's take a common market. Let's take crude, WTI. $1,000 a big figure. And so in your stop loss, which is market determined, could be anywhere from 20 cents to $1.50, say. So anywhere from $200 to $1,500, depending on the circumstance. Well, I thought about this and I thought, well, actually, there's a very simple solution to that. Just take the trades that have the, say, sub $300 stop loss and triple your size. And just ignore the others, even though they have positive expectancy and they're perfectly reasonable trades. Just solely, and in that way, you're still running the same risk level, but you've suddenly tripled your size. So of course your potential upside has massively increased. So like I said, it's definitely not just reducing a stop loss. That's the highway to ruin. But what it is if you can market define stop points and then just take the trades whereby your stop level is much smaller, then you can ratchet up size. And size isn't what makes you the money, it's position sizing. Far more than the perfect entry, which is what everyone fixates on. So that would be one solution. And obviously various forms of options would be other solutions in that realm as well. But that's kind of what I mean about you're still, in effect, you're betting big, but with a small overall risk level, which is the key.
Yeah, okay. But by ignoring trades, you're really changing the dynamics of the strategy, aren't you? So do you adjust the strategy to have these new rules, or do you continue to manage it in its original form?
No, I mean, you would want to do a check just to be careful that all your losses weren't in fact those very low stop loss points, because in that case, okay, that's different. I mean, that's just an example, but that's the sort of concept. And for instance, another example would be, or another solution to this would be, okay, well, rather than using futures, I'll use options, which is not a particularly innovative idea. But for instance, if you're going to do a swing trade and you know anyway that you're going to be out within 3 days because that's what you've tested and all the parameters and all of that kind of stuff, you could well find, if you can tie that to an options expiry, which is relatively easy in the liquids because they have weeklies, or it just happens to occur when a monthly cycle is coming up in the other stuff, then you could find that the time value in that option is actually extremely low. And again, you could get 2 or 3 contracts equivalent for exactly the same view. So it's always got to be the married with you've tested your systems and they're giving you, various results, and you're just choosing to take certain trades. Now, when I say choosing, that's not discretionary choosing, because of course you'd always choose the wrong ones. That's choosing according to an algorithm. So in effect, you're taking a subset of trades, but you're doing it in a very logical, prescribed manner. But that it's always with the end solution of how do I up my size on the same risk, in a useful way. And any trade where you can suddenly trade 3 times the size on the same risk, suddenly your results can start looking really quite spectacular if you avoid all the obvious pitfalls.
Yeah. Okay, well, there are a large number of position sizing algorithms out there, though. Have you found that there are any particular methods that are more suitable than others, perhaps to the style of trading that you do?
Not really. I mean, I have looked at them over the years. I'm certainly not an expert in this. Andrea's very good. Obviously, I suppose the sort of kingpin of all of this is Ralph Vince. I tend to use, if I use anything, well, I do use something, obviously. I use fixed fractional, and I find it amazing how many people end up doing fixed fractional, because it's very simple to calculate, and in effect, the results are pretty much as good as anything else. One thing that does make me laugh a little bit, it's a phenomenon I've seen in various sort of areas of trading, but it's quite prevalent, or it pops up a lot with Kelly in particular on money management. So that's why it sort of suddenly comes to mind, is people will look at the maths of Kelly and really flog it to death. And, they're really the nice big spreadsheets with lots of macros, and we're ready to go. And then Kelly throws out a number, which for your account size, whatever that number would be, say it tells me to trade, tells someone to trade 10 contracts. And then they take one look at that, and then they say, yeah, that's way too much. So what I'm going to do is I'm going to run with half Kelly. And you see, I've seen quite serious people do this. Now, I'm not criticizing the idea, because you're probably right. Kelly will always throw out a far too big a number, because it's not ideally suited to the real world. You certainly don't. The only good thing about Kelly is you certainly don't want to be going above it. But I wouldn't even dream of getting anywhere near it. But the fact that what I find amusing is the number of people who will spend so long on the maths, take one look at the result and say, yeah, so I'll halve that. And then what they've essentially done is invalidated everything they've looked at prior to that.
Yeah.
And you do see that within trading in various aspects, where you flog the maths underpinning these concepts to death, and then you decide you don't like the answer, so you'll just arbitrarily adjust it. You'll just double it or halve it or whatever it is right at the end. And you think, well, why bother with the maths? Why not just go with fixed fractional then, which is very simple, and you barely need a spreadsheet for it. It would just be one line basically. And that's as good as anything else. So that's what I tend to use for my algorithmic stuff.
So do you use fixed fractional for every strategy that you trade, or do you sometimes customize it depending on the strategy performance?
I don't customize it on performance. I'm quite a Luddite in terms of I just have things that I regard either as working or not working. If they're not working, I'm not using them. Now, clearly, there are far more nuanced approaches than that, and I should probably do them, but there's only so many hours in the day. So, no, I don't particularly adjust things in that way. That is an interesting area, actually, but robust is a lot better than elegant and precise. So just go for robust, go for what basically works. And I tend to find that true. So, I tend to use roughly the same sort of numbers for each one. The number that really concerns me, that I think seems to concern other people less, is what you could call drawdown at risk, or it's basically what your maximum loss at any point is. So always in my mind, for instance, I have what type of stop do I have, for instance, and this is something I don't think people bring up very much. Is my stop hard, i.e. rigid, that is the most I can lose? And that doesn't exist in the futures world. But in options world, obviously it exists, because it's if it's a long option or a long option spread, then it's a premium differential, at least until the day of expiry for technical reasons. So at that point, the most you can lose is the premium you paid. Fine, that's a hard stop. No matter what happens, that's what you're going to lose. And then you have sort of hard-ish stops, I suppose, which would be a live stop sat in the market, in a liquid market that's essentially open 24 hours a day. So that would be a currency future, treasury future, stock index future. There are gaps, but they're very small, blah, blah, blah. And then you have, really quite soft stops, which allow for much more problems on certain occasions, but those are the certain occasions you've got to worry about. And those, of course, are markets that are closed for extended periods during the day. And also weekend risk is the obvious one. So, for instance, I'll have rules which I know degrade performance, but I try never to go into a weekend short crude would be one. And the testing doesn't stand up to testing, if you like. But if it ever does stand up to testing in the future, when you look at the past, if that makes sense, i.e. if there's a future event, you will know about it. So I don't, there's certain positions I don't like running into the weekend, because then it's not a hard stop anymore. It's 2 days of a problem, and you open $15 away, and you could have a real issue.
So when you're actually calculating that drawdown, do you make assumptions on some of those stops, perhaps like a buffer, or how do you?
Yeah, I tend to reduce them, if anything, invariably. So whatever my fixed fractional number is, that's sort of the max number, and then invariably I'm reducing them for whatever reason. So I do that, that Kelly thing also, well, I'll just reduce this and I'll reduce that and things, and then I just have overriding things. For instance, I don't want to go short into any weekend. Just if I can work out methodologies and re-entries and stuff that are minimal impacts to performance, that's just going to make me sleep better. Because of course you can't foresee all issues, so I'm sure I will get badly caught out at some point. But having seen how bad things get when people get badly caught out, for instance, the first Lehman crisis, before obviously Lehman went in 98, when there was a problem, and LTCM, which was 98 in Russia, and all that sort of stuff, which I was trading through, then that's really what's coloured my mindset on that sort of stuff.
Okay. Let's move on a little bit to strategy development. So when you're developing new strategies, and if you're already running a portfolio of existing strategies, how do you decide if you should include a new one in that portfolio or not?
Oh, yeah, again, quite a Luddite on this. If I like it, it goes in. Now, obviously, I do have a sort of mental checklist of at least a dozen factors I'm checking through when I'm checking through the performance stats of something. And I'm sure none of the things I look for would be any surprise to an experienced tester. So, you're looking for stuff that isn't skewing your results, too big a loser, too big a winner. It's got to make sense. That's the most important thing. Does this make sense from what I understand? Always try and take a step back on what phenomena is this taking advantage of in the market, and can I sort of see the screen in my head of why would this work? If I can't see that, I get much more jittery about using it. I will sometimes, because something looks very good, but I'd be a lot more leery about using it. If it makes complete sense immediately, then I'm a lot happier with it. And that sort of, those sort of things get stuff kicked out. And also, would I have a reasonable expectation that it would carry on working in the future? That's the other thing. So, for instance, in 2007, when I was testing, within a year or two, I was seeing two separate factors kicking in, which is one, everyone started talking about it, so crowded markets, everyone's getting in. That's always a good time to stop doing something, especially if everyone's getting in because it's free money. As soon as you start hearing that, alarm bell should go off. Like correlation or carry trades or anything. I'm not saying there's anything wrong with them, but it's when people start referring to free money, that's when you need to get a bit freaked out. And also the underlying phenomena driving it, which I did understand what was going on with money flows, that was drying up at the same time. And quite often you actually see those two factors kicking in together. The underlying thing that makes the trade work, and the fact that everyone's jumping in the trade, you see those together. Well, quite often they're interconnected. And that's when you need to get away. So it doesn't matter how good the testing would be at that point, I wouldn't run it, because it would make sense to me. So I think it looks amazing over the past 4 years, and it's probably been amazing over the past 4 years, but it won't be over the next 4, and I'd rather my P&L didn't display it. So.
Yeah. That's an excellent reason why to only trade strategies that you might have an idea of the underlying cause, because you can almost foresee when performance may start degrading. So interesting bit of advice there. So once you've actually stopped trading a strategy, do you still keep an eye on its performance, perhaps reconsider it for inclusion if it goes good again?
I'm not as good at that kind of thing. I have done it in the past, or I archive all my stuff. I have in the past gone through the exercise of, okay, let's rerun everything that we're not doing now. And some of them, you look at them and you think, wow, I am glad I'm not running that anymore. And some of them are very surprising in that they seem to be working well again. But no, I should and I don't. So I mean, that's a sort of growth area for me, I suppose. Other people I know are very good at that, about they religiously sort of monitor everything. So they have hundreds of things sort of sat in a little room running, but without running money and that kind of thing. But no, I don't really do that as much as I should do.
Okay. All right. Thanks, Michael. Now, let's just move on a little bit to discretion and models, because at the start of the chat today, you kind of mentioned discretion. So I'd like to understand a little bit more on how you use discretion when you're a systematic trader.
Well, yeah, I mean, there are different, as I said, there are different gradings of discretion. So it could very simply be that you have a fully algorithmic system and you simply execute it manually. That would be, I suppose, the minimum amount of discretion. If you're going to do that, you do get to the point where you're sort of thinking, well, why are you doing that? Other than potentially, if you've got really big size to do, then you might need execution algorithms and all sorts of stuff that the investment banks have. You know, if you're trying to get 50,000 contracts done, then it's probably not a wise move to just go and buy them at market, because you might somewhat adjust the market. So you know, that's one end of the spectrum. What I tend to mean when I'm talking about that is, well, I have a model. It's specifically telling me a product to buy or sell. The size of the risk is, you know, delineated by the fraction. It gets spat out by the equations. But, for instance, if I wanted to do it in options world, then I've thought about it. I just don't think it's worth the effort of spending 9 or 10 months programming in all this sort of different scenarios to make sure that it all only activates when liquidity conditions are correct, and to get the exact right strike, tie it to the precise maturity date and all this kind of stuff, where you can just do it manually. So quite often that's the discretionary element. I think the issue is when people talk about discretionary with regards to systematic traders, what they're talking about is, I'll choose which trades to trade. And that is a real problem, because you know, as we discussed earlier, you're going to pick the wrong ones. It's almost a guarantee. You're going to pick the ones that don't work, and you just won't pick the ones that are right. So that's what's to avoid. But I think some element of discretion, or if you exercise discretion in a systematic way, for instance, I'm not sure about how that plays out, but you know, from what I was saying about, for instance, just selecting very low risk entry points, but you know, you have a system for doing that. I'm going to take all trades. You can't be, there's no such thing as a system sort of telling you to be long, but you decide to be short. That's just complete discretionary, and looking at pretty graphs, that's something else. But I mean, there are times when it's obvious, and you can take them to their logical extreme. So, for instance, let's just say, you know, I'm just picking a completely random example, but say I was long crude oil, and my stop happened to be $4 away, because it had already had a run up in my direction, and my profit target I could actually see on my screen was 5 cents away. And I'm just going into the petroleum numbers report, for instance. Then obviously you just exit the trade, because what's going to happen if it's a big set of numbers, especially if there's confusion in the market? Then if things work out well for you, you're going to make 5 cents. And quite possibly you're immediately going to lose four big figures. So obviously that's a point where you would just overrule your system. And if that means, you know, the system's purists would throw their hands in the air, then you think, yeah, you're being a little bit too pure and too little a trader in that regard, because that's obvious common sense at that point. So, you know, you only need those sort of examples, but the problem is, as always, it's abused. You know, it's done by people who don't really understand what exercising discretion means, or what it means to them to do it in that manner.
Okay, that's an interesting example. Can you think of any other situations where you may want to override your systems?
Yeah, correlation would be one. You can clearly map that in to any level of complexity you wish. from its very simplest to I can't be long the S&P and Russell and Nasdaq at the same time. I can only take the first signal, or inverted commas, the strongest signal, whatever it is, or somewhat more temporary correlations where you notice that, for instance, two markets are behaving in absolute lockstep. So, for instance, gold and crude oil at different periods will behave in that way. And you can guarantee if one's up 1%, the other one will be up 1%. And then, of course, at other times, not. So you might choose to, during those periods, and they can be quite extended periods, sort of 6 months at a time or something, well, I won't be doubling up my position, because that's in effect what I'm doing. So that could be an example of where you're exercising discretion to reduce the size. But what you're not doing is, if you've got a buy signal in gold and crude, you're not going short either. I mean, that would be, that's a complete contradiction. But you might want to exercise discretion to reduce obvious and permanent correlation, which would be different stock indices or the 10-year bond and the 30-year bond, to all intents and purposes, unless you're actually a spread trader, and more temporary correlations as well.
I think a lot of those examples you mentioned probably can be coded up or systematized, just
to an extent,
just very advanced kind of level. But okay. So now you trade quite a few different strategies. So how do you come up with ideas for new strategies?
Oh, that varies a lot. Nothing very original, I'm afraid. Watch some stuff online. There's amongst the tidal wave of completely dishonest rubbish online to do with trading, there is actually a lot of quite good stuff. So, and some people are entirely genuine and very good and post a decent amount of stuff. Linda Rashka immediately comes to mind, and people like that. Yeah. On the book side, Tom D. Mark, really good. Talking to people is probably the biggest one. Just having a chat with someone. I was having a chat just before doing this call, and something popped up, and I thought, I can think of a trade on that. And you might not even be discussing trading, but it might just trigger something in your mind. So any of those. One thing I would say on the how do you get ideas thing is recording your ideas. I used to have a little black book, which I just filled with trading ideas. And then one day I was jet lagged to an extreme degree, and I left my little black book, as it were, on a train and never got it back. So that was 2.5 years of ideas that had just been jotted down. Often they're very messy, and it's just 2 lines or whatever it is. So I thought, right, this cloud thing, we'll be doing that from now on. So now it's all on Evernote and workflows and things. Yeah. So in reality, if I stopped having ideas from now, I'd still probably have about the next decade's worth of work. So I don't find that's a problem.
Yeah.
But you're always getting new ideas, and mostly in conversation. That's what triggers the quickest to me, because you never want to copy someone else's idea, not verbatim. Often you might think, oh, well, that's interesting, but I bet that would work. I bet he's never thought of doing that in hogs, or well, what about in the overnight market? Or, for instance, like I said, you come up with something that's been flogged to death, like Larry Williams's filling gaps system. But, well, what about in the Chinese market? Now, I have no idea, but I know I've got that line somewhere in a workflowy note to have a look at some point. But yeah, that's kind of how I do that.
Oh, cool. All right, thanks for sharing that with us, Michael. So I'd just like to start wrapping up for today with a few quick closing questions.
Yep.
What's the biggest lesson you've learnt through trading?
That's a good one. There are so many lessons, and invariably you find over the years that the answer's yes, kind of, or yes, but. I think probably that markets confound is the overall lesson. If you ever hear a market can't go any higher, then it can definitely go higher, and it can't go any lower, then it can definitely go lower. This can't possibly happen. Yes, it can. This is free money. Invariably, no, it's not. And there's a lot of implied risk there somewhere. You just can't see it, and also possibly no one else can see it. So I think those are probably the biggest lessons.
Okay. What's the best trading advice you've ever received?
That's probably Larry's email. Well, and essentially, it's something I do kind of believe in, because the subtext is very much, well, just get on with it.
Yeah.
It's the old, what was that guy's name? Tom Baldwin, the biggest Bond guy in the pit. It's just get on with it. You can analyze things to death, but I'm not talking about just rush into stuff. You want to be prepared, but equally, you can, when you're testing something algorithmically, you can never test every single possible element to it. At some point, you're going to just have to put some money on the line and see how it behaves. So I think that's really quite a key learning. So not like I said, not to be unprepared, but at some point you do need to just dip your toes in the water and get on with it. I mean, maybe in smaller size and things, but you need to see how things behave with real money, because theory will only take you so far.
That's a great bit of advice there. Thanks, Mike. Next question. What do you think is the most important ingredient to becoming a successful trader?
It's the sort of that depends type thing.
Yeah.
I think understanding your own psychology. So, for instance, certain types of trading require immense amounts of brain power. I've certainly been in one trading group where that was true. So clearly, I didn't really belong in that. But many other types of trading aren't like that at all. And some people love to scalp, and some people are agnostic to losses to a sociopathic degree. So it's kind of tailoring. The markets will give you almost anything you wish if you understand what it is that your underlying psychology will be comfortable with.
Okay, and what do you think is one of the most incorrect assumptions people make when trading the markets?
Yeah, I mean that's quite interesting. I think probably the most incorrect assumption that people make, and this is in trading, and also it forms the basis of some major systemic problems within the banks and institutions and things, is people simply assume that the recent past is a good predictor of the near future, and everyone's seen the usual disclaimer that goes on the bottom of all sorts of financial promotion about past results are not indicative of future performance, and that's fair enough. But when you look at things like value at risk models and anything like that, then that's precisely what the assumption inbuilt to those models is. So I think from a strictly trading point of view, and just assuming because things haven't been volatile and they will now that they will continue to not be volatile, that's extremely unsafe as an assumption, and the fact that it's inbuilt in untold numbers of risk models and that kind of sort of structural issue is, I think that's the assumption that gets people the most into trouble.
I think that's probably part of the downfall of long-term capital, wasn't it?
Yeah, sure, and it certainly was the problem in 2007-8 crisis. Correlation adjustments, any number of these crises. It's the smoking gun. It'll be a different smoking gun, but that's what's underpinning so many of these problems. So yeah, that's what I'd say.
Okay, cool, nice one. Favorite trading books?
Oh, nothing very original here. I suppose the Market Wizards.
Market Wizards, yeah.
Although one thing I would say on the Market Wizards would be the third one. I found really good, and that's not everyone's done the Market Wizards, the new Market Wizards, the original two, and then I suppose everyone got the new one. Not that new
hedge
now.
funds,
The hedge
I think,
fund,
wasn't it?
yeah, hedge fund Market Wizards and Market Sense and Nonsense, very good. But there was a third one as well that no one ever mentions, and that's not bad at all either. Stock Market Wizards, which is that's pretty good as well. It sort of it depends. So, for instance, if you're starting out or you want a really good introduction that just covers all the bases in a good way, then that would not necessarily a beginning trader because they wouldn't understand it, but someone with a bit of experience looking to really take themselves up to the next level, and that would either be Kevin Davies' book, Algorithmic Trading Systems, or Brent Penfold's Universal Principles book. So if you're in that scenario, so for instance, anyone I hire as an analyst, I basically just tell them that's the first thing they've got to do is read those two books before they do anything else. What else on that front? Money management, Ralph Vince, but they're really hard. I mean, he's a good writer, but there's a lot of maths in it. New money management, I found the most intuitive of his. He's got a dozen books out. Yeah. And, he covers some really nice stuff on that. Things that are really quite technical and a little bit esoteric, like the dampening effect of how you charge fees for CTAs and things. But when you've been in the business for a while, you realize quite how key these sort of factors are and things like that. So any of those. I mean, from the fun standpoint, then, I'm an old Bond guy, so Liar's Poker would be my favourite. But yeah, that's what I would say on the books front.
Ah, cool. Some great books there. And finally, what's the best way for listeners to get in touch with you?
You can link to me on LinkedIn. I pretty much accept anyone who's, doesn't look remarkably like a computer. Or email Michael at, and then all one word, thetradingmasterclass.com. So either of those two would be the best way.
Okay, cool. All right, well, thanks for spending some time with us today, Michael. Is there anything else that you'd like to mention before we finish up for today?
No, I think we've definitely covered some ground there. I hope that's going to be of some use to some people. I like these podcasts. I listen to them. I pretty much listen to all of yours. I think I find that's actually a good. Going back to a very earlier question, that's a very good idea generator. It's just listening to this sort of interview, because it just gets you thinking about all different aspects. So no, I think we covered it all.
Yeah, we've been very lucky actually to have some amazing guests on the podcast as well. Yeah. So thankful for everyone who's participated so far. All right, well, thanks again for your time today, Michael, sharing with us some valuable insights into trading and position sizing, discretion, those type of things. So yeah, thanks again, and I wish you all the best for the future.
Thank you.
All right, cheers. Thanks, Michael, for a great chat today. I found it quite interesting to hear about the approach he used in the 2014 Trading Championships, where he was selecting trades with smaller stop sizes so he could increase the position size. It had quite an impact on his returns, but it may not be for everyone, so you'll obviously have to go and test it out on your own strategies. But I think it's an interesting idea worth considering if you're looking for larger returns. Now, as usual, we have some additional content in the show notes page, so if you'd like to know more, head over to bettersystemtrader.com/39. And additionally, if you have any questions or comments for myself or Michael, please post them in the comments section of the show notes page too, and we'll get back to you. Now, if you'd like to hear loads more trading insights from Michael and 3 other incredibly successful traders, then you may be interested in hearing about the Trading Masterclass being organised for April 2016. The presenters are all World Cup trading champions and successful traders outside of the competitions too. Plus, they've all been guests of the podcast. So how's this for a lineup? Andrea Unger, Kevin Davey, Tim Ray, and Michael Cook. Incredible. Anyway, the masterclass goes over 4 days, but it's not for beginners. It will be an intensive 4 days, so if you're an experienced trader and would like to know more about this event, I have a link with more information on the show notes page, so head over to bettersystemtrader.com/39 to check it out. So that's it for this episode. I hope you enjoyed the chat with Michael. Thanks for listening to Better System Trader.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.